Hedging, a risk management strategy in investing. In the world of finance, hedging refers to an investment strategy designed to reduce or offset the risk of potential losses in an existing position. Essentially, it's like buying insurance for your investments. How does hedging work? Identifying and mitigating risk. Hedging involves taking a position in a related asset that moves in the opposite direction of your primary investment. This counterbalancing position helps to cushion the impact of potential losses. Have an example. Now imagine you own shares of an airline. You're concerned that rising fuel prices could significantly impact the airline's profitability. To hedge this risk, you could buy futures contracts on oil. If oil prices rise, the value of your airline stock may decline. However, your position in oil futures would likely increase in value, offsetting some of your losses in the airline stock. Got that? The key concepts. Risk aversion. Hedging is primarily driven by a desire to minimize risk. Investors who are risk-averse often employ hedging strategies to protect their portfolios from potential losses. Diversification. Diversification, such as investing in a mix of stocks, bonds, and other asset classes, is a form of hedging. By spreading your investments across different assets, you reduce your exposure to the risks associated with any single asset or sector. Derivatives. Derivatives, such as options, futures, and forwards, are commonly used hedging instruments. These financial contracts derive their value from an underlying asset, allowing investors to create complex hedging strategies. There are about 4 types of hedging strategies. Options. Buying put options, the right to sell an asset at a specific price, can provide downside protection for a stock portfolio. Futures contracts, used to hedge against price fluctuations in commodities like oil, gold, and agricultural products. Currency hedging, used to mitigate the risk of currency fluctuations for international investors. Interest rate swaps, used to manage interest rate risk, such as the risk of rising interest rates on a bond portfolio. Here are some important considerations. Hedging costs. Hedging strategies often involve costs such as the premiums paid for options or the fees associated with futures contracts. Imperfect hedges. It's important to remember that hedging is not a perfect science. Market conditions can change unexpectedly, and hedging strategies may not always provide the desired level of protection. Risk-return trade-off. Hedging typically reduces potential returns along with potential losses. Hedging is a valuable risk management tool for investors. By carefully considering their risk tolerance and investment objectives, investors can employ hedging strategies to protect their portfolios from potential losses and achieve their financial goals. However, it's crucial to understand the complexities of hedging and to carefully weigh the potential benefits and costs before implementing any hedging strategy. Any questions? You know how Kindly share and subscribe to our platform.